Good day, everyone. We are from Group 3 and we are going to discuss the topic, which is the introduction to investment. To formally start our presentation, we are going to introduce ourselves as responsible for this topic. I am Jessica Palacio, together with my co-reporters.
I am Clark Renz Narida.
I'm Lady Clasan Cortez. I'm Mishuri Mandan. I'm Chewin B. Cabodo. Julia Pisano D. Abani. I am Tulsi B. Dumokol. I'm Aubrey R. Ikiran. Bernadette Papistan. Ay Kadagan. Geraldine Makawili.
Shanrex Michael Isulayo.
Now, I will discuss what is the meaning of PSEI. The changes in the PSEI are the most of time used as indicator of overall business and market performance. Brown and Riley, 2014, stated that the objective of creating and maintaining security market indicates is to provide a composite report of market performance over a period of time. The Philippine Stock Exchange, in its Guide to Indicates, maintains the following security market indicates to track the performance of market and its sector. The PSIA, this decades contains data on Philippine stock market. Philippine Stock Exchange Index PSEI. Sector indicates volume and value of stock market transaction, market capitalization, and price earning ratio. Scope of classification, the PSEI main index the Philippine Stock Exchange. The second is the Philippine Stock Exchange is to guide and indicates maintaining the following security market indicates to track the performance of market and its sectors. PSEA, the main index. In the case of the PSEI index, it contains the stocks of 300 targets of most actively traded panels listed in the Philippine Stock Exchange. It was previously known as the PIC 6, but the name was changed to PSEA on April 2006. Nevertheless, it still served the same purpose it was before. Recent years, it was reported that our local stock market have outperformed most stock markets globally by comparing the performance of the PSEI against the market index of the other countries. How then would a local investor take advantage and this improving market performance? How would an individual invest in local stock market? Before these questions are addressed, they have six sector indicates. 1. Financials. 2. Industrial. 3. Holding firms. 4. Property. 5. Service. 6. Mining and oil.
Risk return trade-off. Higher risk is associated with a greater probability of higher return and lower risk with a greater probability of smaller return. This trade of which an investor faces between risk and return while considering investment decisions is called the risk-return trade-off. For example, if Company A and Company B make the same products in the same industry, and the only real difference is that Company A's management is shaky and untrustworthy, while Company B's management is solid, Company A's stock should be priced lower than Company B's stock.
Good day, everyone. My name is Bernadette R. Papistal. I will discuss risk aversion. Risk aversion is the tendency of people to prefer outcomes with low uncertainty to those outcomes with high uncertainty, even if the average outcome of the latter is equal to or higher in monetary value than the more certain outcome, which means that the higher averse, the higher return, and the lower averse, the lower return.
Good day. I am here to discuss about the investment and the risk premium. What is investment and what is risk premium? Brown and Rayleigh, year 2014, defined investment as the current commitment of dollars for a period of time in order to derive future payments that will compensate the investor for the time the funds are committed, the expected rate of inflation during this time period, and the uncertainty of future payments. Investments do not have to be in dollars but may be denominated in any other currency. Simply, money which is committed with an intention to earn a return over a period of time may be considered as an investment. The required return of any investment is dependent on the risk faced by the investor, as the risk-return trade-off suggests. The riskier the investment, the higher is the required rate of return by the investor. The required return is computed as required return of any investment is equal to real risk-free rate plus expected rate of inflation plus the risk premium. This means that all investments are faced with the same nominal risk-free rate consisting of the real risk-free rate and the same expected rate of inflation. The required rates of return of various. Ano ba?
In 2014, Raleigh and Brown identified the five major sources of risk. The first one is business risk. Second, financial risk. Third, liquidity risk. Fourth, exchange rate risk. And lastly is country risk. The first one is business risk. It is related to the nature of the company's products and its operating strategy. Business risk is the exposure of company or organization has to factors that could lower its profits or lead it to fail. Anything that threatens a company's ability to achieve its financial goal is considered a business risk. There are many factors that can converge to create business risk. Sometimes it is a company's top leadership or management that creates situations where a business may be exposed to a greater degree of risk. The next one is financial risk. Refers to risk created by the choice of capital structure, the financing mix of the issuing company. A company usually funds its operation through debt and equity financing. As the debt portion increases, financial risk increases as well. Financial risk is the possibility of losing money on an investment or business venture. Financial risk is a type of danger that can result in the loss of capital to interested parties. For governments, this can mean they are unable to control monetary policy and default on bonds or other debt issues. Corporations also face the possibility of the default on debt they undertake but may also experience failure in undertaking the cost of financial burden on the business. Next is liquidity risk. It is an uncertainty that an investment can be converted to cash at a known price. Liquidity risk, the possibility that an individual, business, or financial institution cannot meet its short-term debt obligations. The investor or entity might be unable to convert an asset into cash without giving up capital and income due to a lack of buyers or an inefficient market. Liquidity refers to the ease at which an asset can be converted into cash without negatively affecting its market price. The risk arises when a company cannot buy or sell an investment in exchange for cash fast enough to pay its debts. Next is exchange rate risk, means when an investment is in a different currency than investor's local currency, there is a risk of exchange rate fluctuations. If the investor needs to sell the foreign currency investment and convert it back to their local currency, they need to consider how the exchange rate between the two currencies may change and affect their returns. Lastly is country risk. Country risk refers to the uncertainty in a specific business environment due to political and economic factors. If a country has political instability or experiences naturally disaster like typhoons and earthquakes, the risk of investing in the country increases. Additionally, countries with a higher likelihood of government changes through coups, revolutions, or revolutions have a higher country risk premium, which may impact investment decisions.
Now I'm going to discuss the type of investments and related risks. First, let's discuss what is deposit. Deposit instruments are provided by financial institutions, mostly by banks. There are three major deposit instruments, include the following. First, we have the savings account. Second, we have the checking account. And the third one is the time deposit account. Savings account. It provides a low fixed rate of return but provided the convenience of availability. Here in savings account, we have two ways in where we can save money at the bank. First, we can use the passbook, which is called the small booklet, and the second one is the ATM card. Next is the checking account. Checking account is a depositor with a checking account does not earn interest, but now most, if not all, banks provide a rate of return, although the fixed rate is very low. Here in checking account, it is a less hassle way of paying to your client. Savings account. It provides a low fixed rate of return but provided the convenience of availability. Here in savings account, we have two ways in where we can save money at the bank. First, we can use the passbook, which is called the small booklet, and the second one is the ATM card. Savings account. It provides a low fixed rate of return but provided the convenience of availability. Here in savings account, we have two ways in where we can save money at the bank. First, we can use the passbook, which is called the small booklet, and the second one is the ATM card. Checking account. A depositor with a checking account does not earn interest, but now most, if not all, banks provide a rate of return, although the fixed rate is very low. Here in checking account, you can issue, the depositor can issue a bank check instead of a cash in paying to their client, which is hassle free. Next is time deposit account. A time deposit account usually requires a minimum amount of deposit with a fixed term maturity. Here in a time deposit account, you can earn this kind of deposit can earn a highest interest. Let's just say you have 1 million and you're going to deposit it in a bank. If the contract says that you're going to withdraw the money after 2 years, then that's the only time that you can withdraw your money. That's why you can earn the most, not the most, but the highest interest rate aside from the two kinds of accounts. Next is time deposit account. A time deposit account usually requires a minimum amount of deposit with a fixed term maturity. Here in a time deposit account, you can earn this kind of deposit can earn a highest interest. Let's just say you have 1 million and you're going to deposit it in a bank. If the contract says that you're going to withdraw the money after 2 years, then that's the only time that you can withdraw your money. That's why you can earn the most, not the most, but the highest interest rate aside from the two kinds of accounts. Kamal's rating system is based on the following components. First, what is the acronym of CAMELS? The acronym of CAMELS stands for Capital Adequacy, Asset Quality, Management Earnings, Liquidity, and Sensitivity. The CAMELS rating system is based upon an evaluation of 6 critical elements of a credit union's operations. First, what is capital adequacy? Capital adequacy is a measure of how much capital a bank has available, reported as a percentage of a bank's risk-weighted credit exposures. The purpose is to establish that banks have enough capital on reserve to handle a certain amount of losses before being at risk for becoming insolvent. The second one is asset quality. An asset quality rating refers to the assessment of credit risk associated with a particular asset, such as bond or stock portfolio. The third one is the management indicators. Measures the ability of an institution's management team to identify and then react to financial stress. That category depends on the quality of bank's business strategy, financial performance, and internal controls. The fourth one is the earnings quality. Earnings quality is the percentage of income that is due to higher sales or lower costs. An increase in net income without a corresponding increase in cash flow from operations is a red flag. Next is the liquidity. Liquidity means is your ability to cover any short-term liabilities such as loans, staff wages, bills, and taxes. Strong liquidity means there's enough cash to pay off any debts that may arise. The last one is the sensitivity to risk factors. As a measure of a financial instrument's value reaction to changes in underlying factors. The value of a financial instrument is impacted by many factors, such as interest rate, stock price, implied volatility, time, and etc.
So now let's proceed to the government securities. So the government securities fall under the category of debt securities, and most of them are also classified as fixed income instrument. The national government through the Bureau of Treasury issues known as Treasury Bills and Treasury Bonds. So yung Bureau of Treasury, which is facilitates the management of financial resources, this is a government agency. Basically, dalawa yung trabaho niya, to spend money and to raise money. So, paano nag-spend money? Well, public services, central banking, and monetary regulation, ang mga trabaho niya, infrastructures, ang pagpapatayo ng mga building, roads, and bridge. There's a lot more, but those are the basic. Now, paano naman mag-raise ng pera ang Bureau of Treasury? There's two basic. First, collecting taxes and issuing debt securities. And now we're focused on issuing debt securities or government securities. Ano nga ba itong debt securities? This is what we call treasuries. And there are three types of treasuries. First, treasury bills, treasury notes, and treasury bonds. Treasury bills is a short term because yung maturity niya is less than 1 year. In treasury notes naman, tinatawag natin na medium term because yung maturity niya range from 2 to 10 years or more than 10 years. Yung treasury notes, it is a debt obligation that comes with a maturity of 10 years. It also makes fixed interest payments to the investor every 6 months. And the treasury bonds is a long-term government bonds because the maturity is more than 10 years. So that's all the government securities.
Hello everyone, I'm going to tackle what's in with corporate debt securities. What is corporate debt securities? Corporate issue debt instruments in the form of commercial papers and corporate bonds. Corporate bonds are long-term debt instruments issued by corporation. The term corporate debt security means a marketable obligation evidencing the indebtedness of any corporation in the form of a bond, note, and or debenture, which is commonly regarded as a debt security and is not predominantly speculative in nature. Some of the most examples of security include stocks, bonds, options, mutual funds, and ETFs. So, here are the main features of debt securities. Debt securities should display all or most of the following quantitative characteristics: an issue date on which the debt security is issued, an issue price at which investors buy the debt securities when first issued, a redemption or maturity date on which the final contractually scheduled repayment of the principal is due, a redemption price or face value, which is the amount to be paid by the issuer to the holder at maturity, an original maturity, which is the period from issue date until the final contractually scheduled payment, a remaining or residual maturity, which is the period from the reference date until the final contractually scheduled payment. Bye. The coupon rate that the issuer pays to the holders, which may be fixed throughout the life of the debt security or vary with inflation, interest rates, or asset prices. The coupon dates on which the issuer pays the coupon to the securities holders, and the issuer price, redemption price, and coupon rate may be denominated or settled in either domestic currency or foreign currencies. The default risk attached to debt securities, which is the creditworthiness of individual debt securities issues assessed by credit rating agencies. Bye.
Good day everyone. Before I start, I would like to introduce myself first. I am Erica Jeannie Dugami and I will discuss about the government securities. The basic difference between the government securities are the issuers. The government is a credit risk-free compared to the corporations. Government securities is nagpapautang kita in money or nagpapautang yung company in money ang government. In return, they receive interest. We all know that investing money involves risk, but in this case of government securities, matatawag yang risk-free interest rate because the government guarantees its payment to the company. And secured money nga gintapaw ang company sa government.
So our next topic is about equity securities. So what are equity securities? Equity securities are the financial assets that represents ownership of a corporation. Equity securities are classified into two main categories, which are the common stocks and preferred stocks. So here with me is Sherwin Cabodok to summarize the features of common stock investment by answering our guide questions, and then we differentiate these from a preferred share. So the third question is, can the investment be liquidated immediately at a known price? If the equity investment represents ownership in a listed company, then the instrument is considered liquid since the stock exchange will facilitate the availability of known bid and ask prices for the shares and access to the wide base of buyers and sellers as well. Investors would only need to look for a stockbroker in order for the individual to purchase and sell shares in a stock market. And the last question is, how long is the term to maturity of investment? Common shares do not have a term of maturity. The shareholder may hold the stock indefinitely. Aside from these features, the common stockholders also have voting rights. Also, because of its residual interest, the potential upside of equity return is essentially limitless. Yet, the risk lies in the variability of the returns with a maximum loss equal to the initial investment of the stockholder. Equity investments have higher required rates of return compared to fixed income instruments because of its variability. Preferred stocks differ from common shares in terms of preference of dividends, seniority over claims to assets, and the absence of voting rights. Corporations are not required to pay dividends annually to preferred stockholders, but when they do, they declare dividends. Preferred stockholders also have preference over claims to the asset relative to common shareholders, but not over creditors. Preferred shareholders also do not have voting rights in stockholders' meetings. Dividends paid to preferred shareholders are computed as a percentage of the par value of the shares and thus may be considered as a fixed income instrument because of the similarity in the cash flow pattern. Holding period return, or HPR, for stock is computed as you can see in the screen. So that's all.
While the entity that creates and sells a bond or another type of security is referred to as an issuer, the individual who buys the security is an investor. In some cases, the investor is also referred to as a lender. So, and the second is, who is the issuer of the investment? Only corporations issue common shares. The credit standing of this corporation influence the protection of capital of their shareholder if corporation default on their debt obligation more so that they cannot provide sufficient return or even repay the capital of shareholder. Creditors have seniority over claims to the assets of the corporation. Seniority over claims to the assets of the corporation. The second is, who is the issuer of the investment? Only corporation issue common shares. The credit standing of this so variable investment is an investment with a return comprised exclusively of changes is the value of the asset. Fixed income investment offer a fixed rate of return with the interest getting accumulated over a predetermined period of time. Is the return provided by the investment fixed or variable? Investors earn from equity investment dividend and capital gains dividend. Issued by corporation may vary from year to year since the earnings of the company. Also fluctuate earning period. Companies are most required to declare annual dividends.
So with pooled funds, amin ni-highlight mga investment option kundi na-invest ka ang mga professionally managed funds instead pagpalitin individual stocks. Ini nga funds na recording nihin is more nga investment compared with paghimuhin imo own portfolio. Nakakabuli kini para makasave in transaction, cost, and time, pero nakamabgap in fees. Return are based on the fund's net asset value or NAV per share or unit with gains or losses based on NAV changes.
Alternative investments. Alternative investments are supplemental strategies to traditional, though only positions in stocks, bonds, and cash. Alternative investments include investments in five main categories. Examples: hedge funds, private capital, natural resources, real estate, and infrastructure.
What is a risk measures? A risk measures are the statistical measures that are historical predictors of investment risk and volatility. What is volatility? It is the liability to change rapidly and unpredictably, especially for the worse. A basic risk measures for a single asset is the variance of standard deviation or the square root of the variance of returns. The variance is computed as follows, where RT is the return for particular period, R mean is the average return, and N is the number of periods. Computing the variance involves the following steps. First, get the mean. Second, get the difference of each return and the mean. Third, get the square difference. Fourth, add the square difference. Fifth, divide by the numbers of periods. Good day everyone. I'm going to discuss about risk measure and risk reduction. To start off, what is a risk and what is a return? Risk and return are often to us the two are of finance. Investors are interested in both risk and return because understanding one without the other is really meaningless. In terms of investment, the concept of return is fairly straightforward. Return is the benefit or the profit the investors expects from an expenditures. It is the reward of investing, the reason an investment is made in the first place. However, no investment is a sure thing. The return may not be what the investor was expecting. This uncertainty about what the return will be is referred to as a risk. For example, the following returns pertain to the years indicated for stock X. Using the steps, first we need to get the mean. It is the average return for 5 years. To get the mean, add all the given return from 2011 to 2015 and divide it by 5. Our mean is 16.85%. Second, get the difference of each return and the mean. To get the difference, subtract each year return to the mean. Like in 2011, which has year returns of 16.25%, minus to our mean, which is 16.85%, is equal to negative 0.6%. Negative 0.6% is what we call the difference. Third, get the square difference. To get the square difference, just compute the total difference using squared. Example, the total difference of the year 2011 is negative 0.06%. Just put squared on top of it and the result is what we call the square difference. Fourth, the square difference. Just add all the total square difference from 2011 to 2015. And fifth step or the last step is divide by the number of periods. To get this, just divide the sum of the square difference to the number of periods. The sum of the square difference is 0.015003 divided by 5 is equals to 0.00300006. The standard deviation is equal to the square root of the variance. To compute, the square root of 0.00300006 is equals to 0.05477. That is the standard deviation. Convert it into percent and round off. So the standard deviation of the return of stock X is equals to 5.48%. The greater the standard deviation of the returns, the greater is the risk of single asset. Risk return measure. Assets should be compared based on the both risk and return. The coefficient of variation is simply risk return, measured to compare various assets. It is computed by dividing by the standard deviation of the returns by the mean return. So here is the formula. Coefficient of variation is equals to standard deviation divided by mean return. Using our stock X example, the coefficient of variation is equals to standard deviation divided by mean return. So just substitute the given 0.05477 divided by 0.1685 is equals to 0.32504 is the coefficient of variation. Based on this simple measure, investors should prefer assets with a low coefficient of variation. So pag mas mababa ang coefficient of variation, then mas may hikayat o mas gusto ng mga investors na mag-invest in that company. What is risk reduction? From a portfolio perspective, risk as measured by the portfolio variance or standard deviation can be reduced by combining assets whose returns do not move in the same direction, but at least do not move together. This will accomplish the same objective of minimizing risk for a given level of return. It is then the objective of the investors to look for these assets whose returns are not correlated, less correlated, or better yet, negatively correlated. It is recommended that an investor should not put all his money in a single asset or diversify his portfolio into various assets associated with different industries and businesses. As they say, do not put all your eggs in one asset. So, to listen, para mapababa ang risk reduction, kailangan diri ka lang nakafocus sa usa nga mag-invest sa nga assets.